Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
Welcome to another edition of Talk Money, streaming live on Facebook Monday morning at 9 a.m. Thank you for tuning in. For those of you who might be visiting for the first time, my name is Jeffrey Shank. I'm owner of Andover Advisory Group, a registered investment advisor founded in 1996 based on the fundamental belief that a written plan is the key to reaching your financial goals. And so this show, it's all about money, your money, how to save it, how to invest it, how to protect it from the threats to your financial security. So if you are changing jobs, getting ready to retire, experiencing a major change in your life, this is the show for you. And we've got a special show lined up this morning.
An after-school edition? Special after-show edition? After-school edition?
After-school edition?
Yeah.
We're going to be talking about your investments and what a lot of people consider as a conservative way to invest your money, and that's investing in bonds. And what you don't know about investing in bonds, as the title says, could hurt you or could affect you negatively at the very least, right? So we're going to talk about that today. It can be a little complicated, so I'm going to try to explain it as simply as I possibly can. So you'll have to keep me on track, Lou.
Okay. Yeah.
Because when
I'm
I
a simple man. This should be easy.
When I start to get, that's not what I'm saying.
Yeah. No, that's what I'm saying.
If it starts to sound a little bit too, we're getting too far into the weeds, or getting a little bit too wonky. Then just get me going in the right direction. But it is kind of important. I was reading an article this past weekend, actually, on this particular subject, and because it is kind of important in this current environment that you understand what it means to be investing in fixed income investments. And we're going to talk a little bit today about the college landscape after tax reform.
Bonds of fixed income investments.
Fixed income investments.
Yeah, I hadn't heard that phrase attached to them, and I associate that with something else.
See, because here's what, when you invest in a bond, what you're doing is you're lending money to an institution, whether it be a corporation or a government, could be federal government, could be a local or state government. You're lending your money to that institution, and they, in turn, promise to give you a stated fixed rate of
return.
Income.
Okay.
All right, interest, essentially. And they also promise to repay that principal at some point in the future, hence the maturity date of the bond. Right? So if you buy a 10-year government bond, for example, the government says we're going to pay you a certain amount of interest on a regular basis, and then when that bond matures 10 years from its issue date, we're going to pay you back all the principal.
Right.
Okay? That's pretty much the way it works. Now, the risk is twofold. One is the risk that the institution may not have the money to pay you back.
Always a big deal. Yeah.
Always a big deal. Now, in the case of a corporate bond, there's more risk that they might not repay you than a bond that's issued by the federal government.
Right.
In this case, the United States government.
Yeah.
Right.
We assume they're going to be around.
We assume that they'll be around, but more importantly,
Fluid.
if they don't have the money to pay it back,
Yeah.
they'll raise taxes so
Right.
they do have the money.
They'll take it from you to pay
it back.
me
They'll
back.
take it back. They'll take it from me to pay it back
Yeah,
to you.
right,
Exactly.
exactly.
Yep, you got it.
So you get my back.
Right. So in the case of a corporate bond, though, that's not necessarily the case, and so you have to be concerned about not only the interest rates, the interest rate environment, which we'll get to in a second, but you also have to be concerned about the credit risk, the risk that the institution, the corporation, may not be able to pay you back that principal, right? And so their ability to pay that back largely is a reflection of their credit worthiness.
Right.
And so corporate bond investors are looking at a couple of things, and one of those is the credit rating of the particular company that issued the bond.
Okay.
And that does affect the price, because if their credit rating goes down, there's a higher risk, and so there is a...
You've got to get a higher yield. You should
You have to get which should do what to the price?
raise the price.
Lowers the price.
Well, lowers
right.
the
So,
price.
right.
More
Exactly.
risk, yeah.
Right. So if the
Raises
risk
the
is,
yield, lowers the price.
correct.
Yeah.
Right. And so we should talk about that just for a second.
Yeah.
Right. So bond prices have an inverse relationship to the interest rate, the yield on that particular bond. As that bond yield goes up, prices go down. As the bond yield goes down, prices go up. Right.
Yep.
So, why am I telling you all this? Well, because after the financial crisis, the Federal Reserve, through the FOMC, the Federal Open Market Committee, made a decision to start lowering interest rates. And they did that a couple of different ways. One way was just to lower short-term interest rates, and that is the headline news that most people pay attention to, right? So they meet every so often, 10 times a year, I believe it is, and they come out and they make a statement and they say, we are doing this to short-term interest rates, either raising it or lowering it, right? And that does have an effect on borrowing costs. It does have an effect on the money supply, right? But they also had chosen during the financial crisis to do what they called QE, quantitative easing. And we talked about that a lot on here on Talk Money, and what that meant. And so what they were doing is, because they have the authority to do so, was going into the market and buying U.S. Treasuries. They were just buying up U.S. Treasuries as fast as the government could issue them. They were buying them up. Now, what is the effect of that?
Well, more money in that market, right?
Well, correct, but they were increasing the demand for those bonds, right? By buying up those bonds, competing with other investors, they were essentially pushing up the price, supply and demand, right? They were pushing up the price of those treasuries. And what happens to the yield when the price goes up?
Yield goes down.
Yield goes down, exactly. Yeah. So quantitative easing was this program where they were buying bonds on a regular basis, filling up the Federal Reserve's balance sheet in order to push not only short-term interest rates down, but longer-term interest rates by intervening in the market. Quantitative easing. They did that for several years and stopped sometime during 2014. They stopped buying.
Right.
They didn't start selling. They stopped buying.
Right.
Okay. Well, now, today, it was this article I saw on Bloomberg that dated back to beginning of July of this year, right? They're doing just the opposite of what they did in 2008. They started what we'll call quantitative tightening.
Selling off the bonds.
Yes. Yes. And as of right now, we're talking about $40 billion a month in bonds.
Wow.
That are going into the market, into the bond market. They don't want it. They don't want it anymore.
Right.
They're putting them. They want somebody else to buy them.
Right.
Right. So what happens? Supply and demand.
price goes down.
Price goes down and
Yields go up.
yields go up because
Yeah.
we get that inverse relationship, right?
Yep.
Yeah. So the effect of this quantitative tightening, if you want to call it that, is they're pushing up interest rates not only on the short end but on the longer end of the yield curve as well. We've talked about this phenomenon known as inverted yield curve, right? Where
Yep.
longer term, typically short-term interest rates are lower than longer-term interest rates.
Right.
And occasionally what happens is that gets flipped,
Right.
and that's not a good sign for the economy. And so effectively, the Federal Reserve is keeping that yield curve steeper by selling off these bonds that they have on their balance sheet, which is, by the way, unprecedented. The amount of assets that the Federal Reserve had purchased in order to keep interest rates lower at the longer end of the yield curve. So
What was that number, by the way? Do you have it? Do you know offhand?
what?
I'm just curious. The total number of purchases.
The total number of purchases? I don't have, but it was in the trillions.
Yeah. Big
Yeah.
number.
Yeah, it was a huge number.
Yeah.
Yep. And so, by the way, think about it. If interest rates just naturally rise with the Federal Reserve just holding on to these bonds, what will happen to the value of those bonds that they're hanging on to?
The price go up. Value goes up, right?
Value goes down. If interest rates just naturally, let's say they don't do anything, they just hang on to those bonds,
Okay.
and interest rates just naturally start to rise, then they're holding on to bonds that are
At a
losing
lower-
value,
Yeah.
right?
They're holding on to bonds at a lower rate.
At a higher interest rate, but at a lower value.
Okay.
So their balance sheet starts to
Oh, I see.
right.
Yeah.
So they're holding on to this asset that's losing value. So not only do they want to
Yeah.
not only do they want to see interest rates rise, but they want to be in charge of that
Yeah.
of that rate of rise, because they don't want to be left holding the bag. They want somebody else to buy these bonds.
Nice to be in that position. Be able to control your own destiny.
Yeah. So let's see. So it says here they're letting up to $40 billion of its bond holding mature every month without replacing them, and that's what they're doing. Okay. So they're just letting them mature without replacing them, and that cap will raise to $50 billion later in the year. So maybe it's not so much that they're putting those bonds back into the market, but they're not buying
Right.
anymore, right? And so what will that what will the effect of that be? Interest rates will naturally have to rise. So why is that important to you?
Because it affects the value of my bonds.
Correct. See,
Yeah.
so that kind of investing has been considered
Safe.
over the
Yeah.
historically speaking a safer way to invest your money.
Right.
More conservative approach to investing. You give up a little bit of upside potential return for the guarantee that you're going to get a certain yield. And for years, that was working as interest rates were falling, and the Federal Reserve was buying into the market. You could just, you buy your bond, you get a stated yield, and as interest rates start to fall, the price goes up. So you were actually getting two sources of return.
Yield and appreciation
As
Yep.
interest rates were falling, right? So it was easy.
Yep.
That was an easy decision, guaranteed by the U.S. Treasury, right?
Yeah.
A guaranteed coupon is what it's called, right? An interest
Right.
yield, and your bond prices were going up. Easy money, right?
Yeah.
Today, that's no longer true. Granted, the yield will go up, but the price will have a tendency to fall. And so how far could that price fall, you ask? Well, it's really just math. It really is just math, because it's sort of a complex formula.
Yeah.
But essentially, as interest rates rise, the price of your bond will fall based on what's known as the not the maturity, but the duration of your bond
Right.
or bond portfolio. So if you have a bond portfolio, what you do is you add up all the bonds and you do a calculation of those bonds individually, and then you come up with a calculation of the whole portfolio as to the duration of your portfolio, which generally speaking is less than the maturity, overall average maturity of your bond or bond portfolio, right? So how does it work? It's pretty simple. You take the change in the interest rate and you multiply it times the duration in your portfolio, which, by the way, is measured in years.
Right.
Okay? And that's the rate of change, or that is the amount of change in the price of your bond as expressed as a percentage.
Right.
So let's do an example, right? Let's say that the duration of your portfolio is 8 years, your bond portfolio. The duration of your bond or the duration of your bond portfolio is 8 years.
Right.
And let's say interest rates move 1%, 1 percentage point, or 100, in my world, 100 basis points.
Yeah.
Okay. You just take that 100 basis points at 1%, you multiply it times 8 years, which is the duration in your portfolio. What do you get?
8%.
8%. So you bought an investment that was supposed to be conservative, right? That was sort of safe,
Right.
right? And now you're looking at a decline in value of that bond or bond portfolio or bond fund, for example, of 8%. Is that what you expected when you bought your bonds?
No, it's the whole reason you bought a bond.
So there would be a floor,
Right.
right? You figured, hey, I'm not gonna lose, right? Or even if it does go down a little bit, how much could it possibly go down? Well, in today's rising interest rate environment, it could be significant, and it really depends on the duration of your overall portfolio.
I'm assuming here the duration of the portfolio or the duration of a particular bond is the primary factor here, because all of this only applies if you are in the market with the bond. If you're going to let the bond go to maturity, you get your deal, right?
Well, you don't lose.
You get your yield and your money back.
Correct.
Yeah.
Depending on the institution's ability to pay it back, as we said before. So if it's a corporate bond, that's in question.
Right.
Right.
Yep.
If it's a government bond issued by the U.S. government, well, then there's a good chance you will get it back because it's backed up by the full faith and credit of the U.S. government, right? So, but the value does change in the market.
Right.
Keep that in mind. So if you own the individual bond, I think that's what you're talking about.
Right.
If you own the individual bond, the fact that the price fluctuates may be meaningless to you because you plan on holding it to its maturity.
Right. But if your bond is in the market, in other words, you're not going to go to maturity. You're going to...
Assuming that you're planning on liquidating prior to maturity, selling it into the market.
That's where this all becomes a factor.
Right, exactly. So what if you need that money?
Yeah.
Right.
Right.
So you'd have to be able to hold on to it to maturity,
right,
to avoid getting that loss. But in the case of a mutual fund, right?
Yeah.
You don't own the bond. You own a share of the mutual fund, which owns a portfolio of bonds.
Right.
And so your mutual fund is going to be priced according to the market value of all the bonds in the portfolio divided by the number of shares outstanding on a daily basis. And so as interest rates go up, you can expect that the price of your mutual fund bond portfolio will be declining.
Yes.
It's just math. That's just the way it works. And the fact is that you have no control over when those individual bonds are bought or sold, and so it's up to the manager of the fund to make a decision as to whether or not whether or not those bonds should be held onto, or sold into the market. Well, what if suddenly a lot of people say, I don't like the fact that they looked at their statement, right, and they said, really, down 8%?
Yeah.
Really? That's not why I bought this. And they start to sell that bond fund. Well, now the manager who may have wanted to hold on to those bonds to maturity, to your point, avoiding the loss, the decline in value, right? They have no choice now. they have to start selling those bonds, and as you have put it so well in the past, institutionalize those declines in value.
And they have to change the funds for bonds that are doing better. They're going to have to change the nature of their fund if they start losing shareholders.
Good point. They might have to change, but
They might have to chase.
But just so
value.
just so people know,
Yeah.
that managers of mutual funds don't have the authority to just change investment strategy. There is a stated investment strategy in the prospectus of the bond fund,
Right.
and they have to manage that portfolio within the four corners of that particular stated investment
But they can
strategy.
determine when they sell the bonds and which bonds they hold in the fund.
That they can do.
Yeah.
Right, but they can't necessarily start buying something else
no.
other than what is specifically stated in the prospectus, unless they get approval from a majority of shareholders to change the investment strategy. So it's not that easy. They can't just on a dime, unless it's in the prospectus,
Right.
in the stated investment policy, that they could shorten the duration of the portfolio if they wanted to, if they needed to.
Right.
So that's something to consider. And so when you're so this is very important. So if you do own that bond fund, and if you're in a 401k, chances are you have mutual funds in your 401k. Chances are you're allocated somehow, some way, even if you're using a target date fund.
Right.
There's a portion of that portfolio. There's an exposure to the bond market, and as the and I guess this was the point of my bringing this up today. This is not something that you're hearing on the daily news. Even if you're watching
Right.
the financial news, they're not talking about this quantitative tightening that is going on here at the Federal Reserve, and it will have eventually will have an enormous effect on the yields on these bonds as they stop buying and allow these bonds to mature and stay out of the market, right? Because again,
Yeah.
quantitative easing, the whole point of it was to make money cheaper, to make it easier to borrow money,
Right.
Right. Well, if they stop doing that and they allow these bonds to mature, or even start selling some of these bonds in order to have an impact on longer term interest rates, it will have an effect on those yields. And as those yields rise, the value of your bonds and your bond portfolio will decline. We'll just have to. And so we just gave an example, a 1% change, right?
Right.
So we were below 2% on the 10-year not too long ago. And now we're hovering around 3%. So it has easily moved 1.5% in just a few years.
Right.
Okay? So getting back to my example, depending on the duration of your portfolio, depending on the duration of your bond, 1.5 times 8, you're
Yeah.
looking at now, what?
12.
12 or 13%,
Yeah.
right?
Big hit.
Yes. Yeah, and the
Big hit in an investment
an investment that you
yeah.
thought was very conservative, that wasn't
Right.
exactly, it wasn't going to move. So what's the key? As you said earlier, the key here is the duration
Yeah.
of that bond or bond fund. So if you don't know what the duration of your bond investments are, that's a mistake.
Yes.
You really need to understand. There's a lot of ways that you can do that. You can try and calculate yourself if you want to, but trust me, I've looked at the formula, and it's not an easy thing to come up with. But there are a lot of resources out there that can help you out. But I think you really need to know what you're investing in, and at this juncture, it's probably a good idea to shorten the duration of your fixed income, the fixed income portion of your overall portfolio, as much as you can, as long as the Federal Reserve is trying to normalize. Because normalize, by the way, is probably 4% on the short end, right? And we're
Yeah.
only at 2 at this point,
Right.
right? And on the longer end is probably 6 or 7%, and we're at 3 right now.
Wow. Yeah.
So,
And this is going to snowball, isn't it? As people start to move out of longer duration.
so there's all kinds of risks, I think,
Yeah.
associated here. Keep in mind that corporations depend on borrowing money in order to do business. And as those costs of borrowing go up, it puts a squeeze on their margins. They either have to raise prices or their profits are lowered, right? Makes
Right.
it more difficult for some companies to even borrow money. So that could have an effect not only on corporate earnings, but also on the ability of a company to even do business or to grow, right? So that could have an effect on share prices longer term. Could also have a negative effect on fiscal policy. That is to say, the U.S. government, because one of the things that the federal government does on a regular basis is borrow money in order to finance its operations.
Right.
And it's something that no one is really talking about in Washington right now, the fact that we're still in deficit. The deficit continues to grow. The tax cut package, it looks like, has created a situation where revenues are down because of the cut in the corporate rate
Right.
and personal rates, and spending continues to go up. So we have this widening gap between the amount of money we have coming in and the amount of money that we're spending.
And if debt service gets more expensive,
And if the cost of borrowing that money starts to go up, well, that only, as you said, snowballs
Yeah.
that problem, because now the cost is added on to the increased cost of borrowing is added on to the outgo, and if those revenues aren't increasing as they expect that they should, then we've got a widening fiscal budget deficit. And that puts more pressure on interest rates, right?
yeah.
That puts more pressure on interest rates. Why? Because if the Federal Reserve suddenly isn't buying, supply and demand.
Right.
Okay, let's talk about this, right? Real basic, supply and demand. If the Federal Reserve isn't buying all those bonds that the U.S. government was offering, or has been offering,
Right.
and will continue to offer, right?
Yeah.
What happens?
Price
You have-
goes, less buyers in the market.
You have an increasing supply,
Right.
right?
Decreasing demand.
Decreasing demand. So what happens to the price of those bonds in the marketplace?
Goes down.
Because the yield has to go up in order to compensate.
Yeah.
Yeah, exactly.
Yeah. Interesting game.
Yeah, game. I don't know if so you've got this.
Well, I mean, if
this-
you're on the controlling end, it's an interesting game.
Yeah.
If you're
So-
on the reacting end,
Yeah, well, if you're in the investing end, and that's
Yeah.
what I'm talking about, the average investor, right?
Right.
So we've got this rising interest rate environment, and which is being, I wouldn't say controlled, but
herded.
is being influenced by the Federal Reserve,
Yeah.
right? And then you've got, and that could have a negative impact as those interest rates start to go up. Could have a negative impact on corporations, their ability to borrow, the cost of borrowing.
Right.
Could have an effect on their profits, their earnings, which obviously, in the end, earnings ultimately determine the value of a stock.
Right.
Right. And so as those interest rates continue to rise, we have this effect on corporate America, but we also have this fiscal issue that we have to deal with that isn't being dealt with, and so essentially we've got the federal government crowding out the bond market to a certain extent. What are you going to buy? You're going to buy a corporate bond in a rising interest rate environment, or you're going to buy a government bond in a rising interest rate environment? You want the guarantee that you're
Right.
going to get your money back, just in case the corporation can't, right?
Right.
And so suddenly, the federal government is competing for that investor dollar, and the corporation has to do what in order to compensate?
Offer more.
A higher
higher
yield,
yield, yeah.
which means prices of existing corporate bonds start to decline.
Right.
And what a lot of folks don't realize is that a lot of some of the companies credit worthiness is based on the value of the stock of the company. Right.
Yeah.
Right. So you've got all these things going on that potentially, and I'm not trying to sound the alarm here, but I think you need to pay attention to it. We've got this situation where the stock market has been very healthy for a long period of time. They're talking about perhaps this bull market, depending on how you measure it, being one of the longest in the history of the U.S. stock market. And then you get bond yields going up and bond prices going down, almost assured, right? So those are your two traditional asset classes that most people allocate to. And typically, when one isn't doing well, they move to the other, and vice versa. So if both of them are not doing well in the shorter term, where do you go? What do you do?
Which tent do you move to now?
Now where do you go? Right?
Yeah.
So I think for purposes of our discussion today, we should mention that there are alternatives to the stock and bond market, and there are alternatives to investing in the bond market to give you that exposure without having to take the interest rate risk. So I guess the takeaway here is you really want to pay attention to the duration of that fixed income.
You need to find that out right now.
You need to find out what your duration of your portfolio is, and what kind of exposure you have, downside exposure, if interest rates continue to rise, which I don't see any reason why they won't continue to do so, because the Federal Reserve has expressed their intention to continue to raise short-term interest rates, and in October they're going to go from $40 billion to $50 billion that they're basically putting back into the bond market every month. Yeah, every month. So they have every intention of pushing interest rates higher.
So few things are sure, but it looks like it's headed in that direction.
Looks like, well, barring any unforeseen events, some geopolitical change, the Federal Reserve. The funny thing is about the Federal Reserve, they like to think that they're ahead of the curve. Generally speaking, they tend to overshoot. One way or the other. So when they're in a easing mode, they tend to overshoot to the downside, and then when they're in a tightening mode, they tend to overshoot to the high side in terms of where interest rates are.
They oversteer.
They typically do, and they have to make these sudden course adjustments. Even if we see the negative effects of these rising interest rates, both in the bond market and the stock market, my guess is they won't immediately change course.
Right.
They'll wait because they're data dependent. And typically the data that they're looking at
is trailing.
Yeah. Exactly.
Yeah.
So they might come to the conclusion that things have changed, and every once in a while they have an emergency meeting.
We love those.
If you hear that,
I love it when the Fed's having an emergency meeting.
When you hear that the Federal Reserve is having an emergency meeting of the Federal Open Market Committee, pay attention. Yeah, definitely want to pay attention.
They got some data they didn't like,
or the data isn't the data they're looking at doesn't reflect the reality on the ground in terms of what's happening in the markets, and they start to scratch their head and say, maybe we got it wrong.
Because doesn't the market and individual money management tends to oversteer as well, doesn't it?
Yeah, I'd say yeah, that's probably true as well. Yeah, but reacting to most investors, whether it be bond investors, stock market investors, or any sort of investor, is always thinking ahead.
Right.
What do things look like 6 months from now? Right. And here you got the Federal Reserve looking. They say they're looking ahead, but they're looking at data that's 30 days old.
Right.
That probably at best, right? And so the markets are a clue as to what's really going on, whether it be the stock market or the bond market. So So I guess the bottom line here is take a look at your portfolio. Don't assume that your fixed income portfolio is not going to change in value to the downside.
At a minimum, that's your job for the week, right? Know your duration on your bond portfolio. Know your duration.
Yeah. Know your duration. Little slogan, right? Know your duration.
It's job one for the week.
Job one, yeah. So I wanted to. I've been thinking about this for a while. And, I know it can be sort of complex, and I wanted to try to make it something that most people could use and understand the risk that are associated with this, so that you don't walk away saying that doesn't mean anything to me. So why bother, right? So it is kind of important, and it is
because your duration is a multiplier of your risk here.
Yes.
In other words, if it's 4 years as opposed to 1, that's 4 times more risk you're exposed to.
Yeah, exactly.
So know what your duration is.
Yeah,
and
so
then that's the start of the conversation.
Right. So if you've got a duration in your portfolio, in your fixed income portfolio, it's 5, 6, 7, 8, 9, 10 years out, you probably might want to take some steps to somehow lower that in light of what's happening in the bond market in terms of higher interest rates. So, hey, we'd be glad to help you out with that too. Certainly, you could take advantage of our no obligation initial consultation.
How complex is that? That's not a kitchen table computation, I would imagine. Although if you're in a bond fund,
I'd be glad to give you the formula if you wanted to do it yourself.
Would the bond fund, would that be part of the information that's generally available on a bond fund?
On a bond fund, yes.
Yeah.
You could probably find that.
It's duration.
It's duration.
Yeah.
Yep. Yes, you could.
But individual bonds, you got to figure that out.
Or your overall, yes, you have to figure it out, but your overall portfolio, I think, is important.
Over several.
How it blends. Just because
over a couple funds and individual bonds that you might own. Yeah.
Right. So you want to take a look at the entire package. So again, that's something that we can help you out with. Certainly take advantage of that initial no obligation consultation. Come in, bring in your statements, and on all your bond funds, we'll do the calculation for you. I don't sit there with a.
Do you have the formula on the wall somewhere so people can see? I imagine that's a beauty.
We do have a tool. We do have a tool that can do all that calculation. We just throw in the specifics of your particular portfolio, and we can, in a few minutes, we can come up with a good idea of what your risk exposure is. Mm-hmm. So. Yeah, take advantage of it. Telephone number to call me after the show, 877-475-2062. 877-475-2062. Or you can send me an email. It's jeff@talkmoneyradio.com. Be glad to talk to you about that. And so coming up, we are going to talk about the tax reform and how it affects those folks that are facing college expenses in terms of the Tax Reform Act. What do they call that? I'm not even sure what the heck they call it.
Make America Great Again.
Make America Great Again.
The Make America Great Again Tax Reform Act.
Yeah, so that's the one that went into effect last year in December, and did have an effect on college financing college expenses. So I want to just go over a few points there. So please stay tuned. We're going to take a break, but we'll come back and talk about that particular issue.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
welcome back to Talk Money. Thanks for staying tuned and staying with us as we talk about personal finance. A lot of things that we think are important that could affect your financial situation.
I avoided the popsicle headache on that first segment. So
I'm sorry?
I avoided the popsicle headache on that first segment, so you did a good job.
The segment on bond duration and quantitative tightening.
That's right.
Quantitative tightening.
First time I've heard that phrase, by the way.
Just the opposite of quantitative easing.
That's right.
Bottom line is, and I'm not going to get into a great detail here, but listen to that first segment.
Yep.
If you wanted to know
yeah.
what the risks were in your safe fixed income investments, you definitely want to tune in.
Do you know what your bond duration of your portfolio is? If not, find out.
Find out.
Find out now. Find out now. Yeah.
So we wanted to move on and talk about the Tax Reform Act that went into effect last year, and some of the changes that would affect people who have kids in college. We're going to talk about those plans, those savings plans that are categorized under Section 529 of the tax code. That's where it gets its name. They come in many varieties. Everything from you can buy your tuition guaranteed at a particular college and don't have to worry about inflation, or you can set up accounts where you can put money away and save it on a tax-deferred and eventually tax-free basis. We'll talk about that in just a second. A couple of things I did want to mention, though, that did go into effect for the 2018 tax year. One is the loss of personal exemptions. This wasn't talked about a lot in the discussion about the changes. Everybody focused on, or all of the proponents focused on the increase in the standard deduction, making it easier for you to file taxes. But with the increase in the standard deduction came the elimination of the personal exemption. That's that dependent exemption, which was worth over $4,000 per dependent on your income tax return. So a family of four would take 4,000 times 4, and that'd be $16,000 that they can no longer reduce their taxable income, right? So that went away. Again, the standard deduction was supposed to replace that to a large degree. But there's also a new family tax credit for those dependents who are not considered a qualifying child. In other words, they're under age 17. So in order to get the child tax credit, your dependent child has to be under age 17. So if they're in college,
right,
they're not considered a qualifying child. And
Sadly,
so you don't get that big child tax credit, right? But there is a new so-called family tax credit of $500 per qualifying dependent. And a qualifying dependent in this particular case would be someone who is in college full-time.
Oh, yeah.
So, dependent college student. Yep. There are income thresholds, though. So if you're making over $400,000 as a joint filer, you don't get the credit.
Yeah.
Just want to point that out.
Yep.
Right. There's a new calculation for the kiddie tax. You know what the kiddie tax is?
No.
So a tax saving strategy for years.
The cat tax
was
kitty tax,
income shifting, where you would take income producing assets, you would move it into your son or daughter's name, and they would be taxed at their rate, right?
Yep.
And I'm not sure when they brought this in. Probably the 80s, the big tax reform that was done in the 80s. They created this kiddie tax, which says that if your son or daughter is making over a certain amount of investment income, interest, dividends on assets, on investments, then you suddenly you have to be taxed. Your son or daughter is going to be taxed at your rate, your marginal rate.
Wow.
With the option of just taking that income and putting it on your own personal income tax return.
Right.
To save time and effort in terms of filing tax return.
Because there's no gain to do it the other way.
Right, exactly. So they call that a kiddie tax. They actually raised the age some time ago that the kiddie tax applies. It was hard to believe. It was up to like 16 and then 18. I think it's higher now. The new twist now on the kiddie tax in the tax reform legislation is that the kiddie tax is going to be calculated if it's over $2,100 in 2018, will be taxed using trust and estate income tax brackets. So you're no longer taxed at your rate. Everybody, if their children have investment income over $2,100, is going to be taxed at estate and trust rates. Now, that probably doesn't mean a lot to a lot of people.
Yeah.
There are very few standard deductions at the estate and trust level, and the tax rates are actually higher.
Yeah.
So it's extremely possible that this could be, the taxes on this income could be higher than it would be under the old rules. That's what you need to know.
Yeah.
So making it even more difficult
God.
to
So complex.
to shift.
Just trying to get my kid through college.
It's called income shifting.
Yeah.
So you take the income off of your tax return, put it on your son or daughter's tax return. It still worked to a certain degree, even with the kiddie tax, but now it's going to be even less effective because of the new rule that says that it's going to be taxed at estate and trust income tax rates.
So if you're doing income shifting with your kids over the last year or two or more, you need to look into this.
Yeah, and not to mention that for purposes of financial aid, it's probably not a good idea to have assets, money in your son or daughter's name,
right?
Because
that's will show up on the financial aid.
The formulas weigh more heavily money that's in the student's name, figuring that, hey, this is money that they got from grandma and grandpa, and was intended for college.
Meant for us.
So it's meant for us. So
that has our name on it.
Right.
Yeah.
So that gets into another area of planning that certainly we can help you with if you decide to. But I wanted to talk more extensively about the 529 accounts, because what they did with 529 arrangements is change the definition of a qualified distribution to include not only college education, but K through 12.
Oh, interesting.
Yes. And put a limit of $10,000 on an annual basis that you could withdraw. Right?
Well, that gets you the bulk of a tuition in most cases.
So private, religious, but excluded homeschooling. So you can't.
Yeah, you can't just take this. Just can't take the 10 grand as compensation for homeschooling your kid.
No, you can't even buy. I guess you can't even buy books with it. Okay,
it's probably reasonable and smart.
Tuition expenses. It says, what it specifically says, tuition expenses. I haven't had a chance to research this,
right?
But it specifically says tuition expenses. So to the extent that I know for college expenses, it could include things that you need for that course that you're taking, including if you needed a computer, a computer was required, it would cover that. It also covers room and board for college.
Yep.
It also covers things like books to the extent that they are required for that particular course. And in this case, it says specifically tuition expenses. So you might be limited to just that private school tuition, but $10,000 probably covers. You're probably not going to be able to get much more than. If they're putting a cap of $10,000 on these withdrawals, that pretty much covers tuition, right?
Yeah.
Probably just barely covers the tuition at a private high school, or actually K through 12. So this is K through 12. So if you want to send your son or daughter to a private grade school, and you have a 529 account, you can pull that money out.
Help out there.
And help out there. Yeah, exactly. Yeah. And there is they've also expanded the Coverdell Education Savings Accounts, ESAs, sort of like an education IRA is what they call it, right? So now ESAs, Coverdell ESAs, let families save up to $2,000 per year for K through 12 expenses. So before it was that was always available, but you couldn't put that much in. Up until now, they were the only option for tax advantage K through 12 savings. I'm sorry, I read that wrong. Let's see. And
Didn't even
also
know this
the ability,
program existed.
I'm sorry?
I didn't even know this program existed.
Yeah. So, let's see. Let me just go back and read this again, make sure I didn't do it wrong. So, Coverdell ESAs let families save up to $2,000 per year for a child's K through 12 or college expenses. Up until now, they were the only option for tax advantage K through 12 savings. Okay, I see what you're saying. They're saying that Coverdell ESAs could actually be impacted negatively. So they haven't made any changes to the Coverdell ESA. I apologize. But there is this other addition to the 529 accounts that allow people to roll over or transfer funds from a 529 account to an ABLE account. Have you heard about the ABLE accounts?
No.
So an ABLE account is a tax advantage account that can be used to save for disability-related expenses for individuals who become blind or disabled before the age of 26. So like 529 plans, ABLE plans allow funds to accumulate tax-deferred and withdrawals are tax-free when used for a qualified expense. So you can actually transfer money now from a 529 to an ABLE account under the new tax reform laws. So it really
You couldn't really seriously. You couldn't do that before.
You could not do that before. Yeah.
If your child was blinded, you couldn't take your 529. That wasn't a qualified.
It wasn't an ABLE. So it wasn't. So the ABLE account is a totally separate account.
Yeah.
But now they're saying that if you've got a 529 account, you can transfer it over to an ABLE account.
Right.
Right. And you're not using that money strictly for education. That's the point.
Yep.
So the other thing I wanted to mention about this is that there's a new tax. I bet you didn't know this. There's a new tax on large college endowments under the Tax Reform Act.
Excellent. I like this.
You like this?
I like this a lot. It's tax harvest.
Yeah,
$6 billion endowment.
Tax somebody else.
Yeah.
Right.
No, hey.
Yes, tax somebody else. Right. The tax law creates a new
I think if the school is able to put together a $6 billion endowment, it's doing pretty well.
The tax law creates a new 1.4% tax on the net investment income of large college endowments. Specifically, the tax applies to institutions with at least 500 tuition-paying students and endowment assets of just $500,000 or more per student.
Per student.
Approximately
$500,000 per student.
Per student. Approximately 30 colleges.
There are schools that have $500,000 in investments per student enrolled. That's what you're telling me. In fact, there are a bunch of them, is what you're telling me.
Apparently, there are 30.
Yeah. Okay. All right.
I'm sure we could probably come up with a few of them right in the local area.
Yeah.
Approximately 30 colleges are expected to be swept up in this net in 2018, including top-ranked, larger universities and smaller elite liberal arts colleges. Some affected colleges have publicly stated the tax will limit their ability to fund certain programs.
Oh, yeah, okay.
Including financial aid programs.
Yeah.
So that is kind of important.
They're threatening financial aid. They have half
however
$500,000 in reserve for every student, and they're threatening financial aid.
However you want to describe it, the bottom line is they're going to be paying out 1.4% tax on the net investment income. So now they're only going to have 98.6% of that income available for paying for certain
only
programs, including financial aid.
$440,000 per student in investment.
No, it's not a tax on the asset. It's not an asset-based tax. It's a tax on the income. So another 1.4%. Now, most of these institutions, if not all of them, are nonprofits. So they've never paid taxes on any of this stuff, right? Now they're paying 1.4% tax on the net investment income. And so that could affect it truly could affect, all kidding aside here, it truly could affect the amount of financial aid that's available in probably 2019, right? 2018, 2019 school year, because this tax goes into effect in 2018.
Schools.
I'm sorry?
For these 30 schools.
For these 30 colleges, correct.
Yeah.
Yep.
So if you're sending a kid to Harvard, you may take a
I didn't say it was Harvard.
financial aid.
I didn't say it was
I'm willing to
Harvard.
bet Harvard is one on that list. Just saying.
But it could affect your ability to get some financial aid at least 30 colleges.
If you're sending your kid to
If
Harvard.
you're sending your kid to one of these 30 colleges.
Yeah.
Whichever they may be.
whichever they may be.
Whichever they may be. So
I got to look at some of those figures.
which again is another good reason to do your homework when it comes to financial aid, because a lot of people think that they don't qualify for financial aid.
Right.
Turns out they could have. In fact, studies have shown that there's billions of dollars that are of financial aid that's left on the table simply because parents thought because they went to the senior night that they found out that. Or they thought that because they talked to the counselor, right?
Yeah.
That somehow they wouldn't qualify for financial aid.
Apply.
So don't assume.
What do you get to
Don't
lose?
assume.
Apply.
Right, exactly. And we can help you in that respect also. So if you want to talk about any of these subjects in a relaxed, no obligation, no pressure situation, take advantage of that initial consultation. Give us a call, 877-475-2062 at the office. Send me an email, jeff@talkmoneyradio.com. Looks like we're running out of time. Thanks for tuning in today. Appreciate you taking the time. And we'll be back next Monday, same time. Remember, good sound advice is better than advice that just sounds good. We'll see you next week.